HR 1, the One Big Beautiful Bill Act. So we're going to be digging into this over the course of several episodes, several videos in which we're going to be talking about what's in it, the top 10 things that are in it, and why you should care about any of it. HR 1 was signed into law on July 4th, 2025 by the 119th Congress. And essentially it extends the Trump era tax cuts and makes some sweeping changes to deductions, credits, and compliance for individuals and businesses. And so there's a wide range of sentiments about this bill. So those who support the bill are praising it for its pro-growth and pro-small business aspects. And those who criticize the bill, who have expressed some concerns about the bill, are warning of a rise in deficits and inequality. And so why does this even matter to you? Why should you care? Well, again, the bill affects small businesses, entrepreneurs, nonprofits, and pass-through organizations like LLCs, S corps, and sole proprietors. So you really want to pay attention to this bill because it impacts you. And there's over 1,000 pages that most people don't even really understand. So that's why I'm here. I'm trying to really distill a lot of this information into the top 10 things that I think business leaders should be thinking about because this bill is so dense. So what can you expect? We're going to be looking at this from a strategy perspective, breaking down some strategies that you could potentially implement in your own life so that you can take positive steps towards your personal or professional success while this law is in effect. Without further ado, let's get started. Number one on my list of the top 10 things that businesses should be thinking about is the auto loan interest deduction in section 110104. So what it does, it allows for deductions up to $10,000 a year on interest from auto loans for U.S. assembled vehicles. Now, this is going to go from 2025 to 2028. Who is going to be able to qualify for this deduction? So you're looking at individuals with an adjusted gross income of under $100,000, and for married individuals, it's going to be under $200,000. Why does this matter? So fleet heavy businesses, delivery, real estate, field teams, things of that nature can lower their taxable income if they're taking deductions on U.S. assembled vehicles, this particular deduction on U.S. assembled vehicles. Now, some of the expert insights that I found from this and what people are saying is that some of the net benefits could actually be reduced by rising tariffs. And this is a very real thing. You know, folks are saying that while we may be able to see some benefits from deductions like this, the tariffs are going to offset that, and we're going to be back to square one. So what strategy can you explore within your teams, with your lawyers, with your CPAs? Number one, look at strategies that favor U.S. assembled vehicles or purchasing U.S. assembled vehicles, because U.S. assembled vehicles are favored under this particular provision. Now, the second part is using financing instead of leasing to claim the deduction. I know a lot of individuals prefer to lease, but if you're financing a vehicle, this is how you will benefit the most. But again, check with your CPA on this because you want to make sure that you are consulting your lawyer and your CPA to make sure you have a comprehensive and well thought out strategy with respect to this particular item. Number two, no tax on tips. I actually love this one, and particularly just because of the messaging. I think the messaging here is really strong because it resonates with people. I'm not here to agree or disagree with the impact of this particular provision because, as I said, many people have varying perspectives and feelings on the provisions in the Big Beautiful Bill Act, this being one of them. I'm only here to share the information so that you can empower yourself with this information and make choices that are best for you in your life and your business. So what does the no tax on tip and provision and overtime provisions do? What it does is essentially it offers deductions for cash, tips, and overtime pay for up to $25,000 per year. And this is going to last through 2028. Now, who's eligible? Workers earning less than $150,000 in adjusted gross income. Why does this matter? It essentially raises the take-home pay without increasing gross payroll for businesses. And some experts are saying, from the Bipartisan Policy Center, that this provision could yield about $124 billion in relief for workers. So there are some individuals who believe that this will have a positive impact. So what's the strategy here? Now, number one is to adjust your payroll systems. With this on the rise, or with this particular provision, you want to make sure that your payroll systems are accounting for this particular change. So reach out to your CPA, get additional guidance on that. The next thing is to promote this to boost employee retention. This can be a tool that businesses can use to boost employee retention in businesses where overtime is increasing and or where the tax, where tips rather, are a core component of that business. Number 3, permanent pass-through deductions. Why does this matter? Well, this essentially permanently extends the 20% deduction on qualified business income. So who does this impact? LLCs, your S corporations, partnerships, and your sole proprietorships. Why does this even matter for that group of individuals? It locks in predictable tax savings for the non-corporate business owners. And so this is why this matters for that group of people. But again, there are a variety of perspectives on whether or not this will be positive or negative, depending on your perspective. And so some experts are saying that this is going to cost $820 billion and that the benefits are going to be concentrated among the high earners. And this is coming from some folks over at the Congressional Budget Office. So what's the strategy here? Well, number one, reevaluate your entity structure. So if you're not an LLC or an S Corp or a partnership or a sole proprietorship, and you might be able to take advantage of this, then you might want to, and you haven't been able to take advantage of this, you might want to reevaluate your structure. And that's where you talk to your lawyer and you sit down and have an honest conversation about how your business is structured and whether or not you can actually go after this particular benefit. The next thing would be to adjust compensation models toward distributions. And so adjusting your compensation models towards distributions could also be a good play here, because it allows you to essentially get more out of this provision after you've ensured that your business is structured appropriately. But again, you want to talk to your lawyer, your CPA, to make sure that you are implementing this provision or the strategies for this provision appropriately. 100% bonus depreciation. So what does this do? 100% bonus depreciation under the Big Beautiful Bill, I can't even say it. The One Big Beautiful Bill Act allows businesses to immediately deduct 100% of qualified capital investments. And so why does this even matter? This boosts your cash flow and it reduces your taxable income. So this is huge, especially for those individuals that have a lot of capital investments. So you want to be very vigilant here. Who does this apply for? What does this apply to? Equipment, machinery, vehicles, and there are going to be certain technology upgrades that are also applicable here. So what are the experts saying about this particular provision? Well, this particular provision could raise GDP by about 0.08% over time. And this is coming from the Tax Foundation. So what's the strategy here? How are you going to actually benefit from this? Well, conduct a CapEx audit. You want to make sure that you're looking at your capital expenditures and you're really aware of what could be impacted by this particular provision. The next thing, as far as the strategy, schedule purchases to take full advantage of the accelerated deduction. So you want to make sure that you're purchasing at the right time. Timing is going to be everything here. Number 5 is the SALT deduction cap being raised. And what this does is increase the state and local tax SALT deduction cap to $40,000 through 2029 for people who make under $500,000 in adjusted gross income. Why does this matter? Personal tax savings for pass-through owners in high tax states could be realized here. And what experts are saying are that, benefits may skew to individuals who make more money and ultimately enable more reinvestment. Now, what's the strategy here? Rethink home office designation, executive comp, and HQ location benefits. This is going to be key for you to consider here because all those things would fall under that SALT umbrella. But again, you want to talk to your CPA, talk to your lawyers to make sure that you are implementing this strategy appropriately. So number 6, the Trump accounts for children. What this does is it creates savings accounts for children, $1,000 seed funding at birth and $5,000 annual contribution cap. This is going to last from 2025 to 2028. Why does this matter? It encourages intergenerational wealth building, which is something that's very important for me. And if this is something that's important to you, I absolutely think that you should dig deeper into this to see if you could benefit from this in your life and in your business. Some experts are saying that this is modeled after the baby bond proposals to reduce future inequality. And so that's one benefit that folks have highlighted here. But ultimately, what's your strategy? As a business, one thing that you can do is promote this as an employee benefit, essentially matching contributions to boost retention and morale. And this is just one strategy. So consult your teams, consult professionals, your lawyers, your CPAs to really come up with a comprehensive strategy around Trump accounts and how you can use it to really build a strong culture within your business. So number 7 is the senior standard deduction. So what this does is it adds an extra $4,000 standard deduction for taxpayers that are age 65 plus through 2028. Why does this matter? This could essentially reduce taxable income for senior executives, consultants, and retirees. And some experts are saying that this aims to offset the inflationary pressures on people that have fixed incomes. Now, what's your strategy here? One strategy could be to to look at the core components of this particular provision and build it into your retirement planning tools that you have at your organizations, and consider this for your part-time or your phased retirement arrangements that you have for your employees. So, and that's where you get with your HR departments. That's where, again, you bring your lawyers and other smart professionals, your CPAs to the table in order to come up with a comprehensive strategy here. Number 8, the clean energy credit restructuring. What does this do? Clean energy credit restructuring eliminates the personal clean energy credits, things like solar, EVs, etc. It preserves industrial level depreciation and credits. Why does this matter? Residential incentives are now gone, but commercial scale investments still qualify. So this is going to really impact the way people make spending decisions because those incentives are now gone. And what experts are saying is that potential job loss in clean energy could be on the horizon, but shift towards larger projects and investments. And this is coming from folks over at the Guardian. So what's the strategy here? Reframe your sustainability goals around industrial projects. I know a lot of organizations have really been focused around sustainability, and they've approached it from the perspective that consumers might be incentivized by some of the clean energy credits that they would be receiving. However, now that there's a shift in that, this is something worth revisiting. And the next part to that would be seeking state level offsets for residential projects. And so this is a little bit more complex. But again, this is where you get your smart people in the room, your lawyers, your CPAs to really think through this particular strategy or a strategy like this so that you can more effectively navigate the clean energy credit restructuring provisions within this bill. Okay, we're almost there. Number 9 is the 1% excise tax on remittances. This is going to be huge for individuals that have a global supply chain network. Why does this matter? What does this do? Let's start with what it does. It imposes a 1% tax on money sent abroad for goods, services, or compensation. Why does this matter? I remember the days where everybody was clamoring to outsource. That's just what you did. You sent your business overseas so that you could get people to do the work at a lower cost, and you could bring a cheaper product to market, whether it be domestically or abroad. Well, that landscape is changing now, and this particular provision is increasing the cost for your global operations, your contractor payments, or your overseas staff. So if you're someone that has a global supply chain network, this is something that you want to be paying a lot of attention to. Now, experts are saying that this could disproportionately impact remittance heavy industries like logistics and digital services. So if you're in either of those industries, now is the time to scan your environments to see how you need to adapt. So what's the strategy here? Part of the strategy is for you to restructure your international payment terms. Get with your lawyers, your CPAs to look at your existing terms and see where you might be able to adjust those terms in order to benefit from this particular provision. It's going to be hard to benefit from it, but it's going to cause you to change your behavior. That's what laws do. They govern and help to guide individuals in the direction of behavior that governments want those individuals or businesses to go. And so you have to adjust your behaviors to find the benefit in this particular provision. And the other part would be to consider payment batching or alternative service vendors. So you might not, again, be able to go to the same vendors that you have abroad. You might have to go domestic. You might have to go in other areas in the international space. But this is something that you're going to have to sit with your teams to examine more keenly, your professionals, your lawyers, your CPAs, to see how you can benefit from this provision. So as I land this plane, I'm going to touch on nonprofit tax compliance provisions within the bill. What it does is it authorizes the Treasury to revoke nonprofit tax exempt status for organizations found to indirectly support terrorism or violate federal funding rules. So why does this matter? Foundations and charitable arms of businesses are going to be facing an elevated level of scrutiny. So who you are doing business with is going to matter a lot during this time as we navigate this new provision. And experts are saying that legal advisors are going to need to stress the need for new risk protocols. So you're going to have to look at who you are doing business with, especially if it's on a global scale, as a new risk that needs to be discussed at the highest levels of your leadership, because that's where, some of the key risk and environmental risks need to be analyzed and understood. Who you're doing business with and who they're doing business with is going to matter even more during these times, and how terrorism is defined is going to matter a lot during these times. So what's the strategy here? One strategy could be for you to conduct, if you're a nonprofit organization, to conduct an annual audit of your nonprofit partners. Again, who you're doing business with and who they're doing business with. And the other part to this particular strategy would be to strengthen your grant oversight and governance procedures. I've worked with nonprofit organizations that struggle with grant oversight because it can be a beast to keep track of all of the different things that you need to understand with respect to your grants. And so it's going to be very critical for you to have redundancies perhaps built into your grant oversight procedures to ensure that you are vigilant about who you're doing business with and how it's perceived, and whether or not it could be perceived as you supporting a terrorist organization or supporting terrorism.